Now to talk about these strategies better, as Pratik mentioned, we have a couple of them strategies we'll be talking about today. Because if we cover all four, it will be like too much. So we'll be covering two topics today. To talk about that topic, I would like to invite Sankaranarayan Krishnan, who is a Quant Fund Manager for PMS and AIF at Motilal Oswal AMC. Apart from the fund management, his additional responsibility also to spearhead the entire research piece on the quant side and the specially factor side. He comes with over a decade of years of experience in factor investing and quant investing. Previously, he was working with Alpha Alternatives, and he also spent time with MSCI, where he actually was constructing multi-factor and ESG solutions for global pension funds and sovereign wealth clients. Okay. So he carries a huge experience on this side. I would like to, Shankar also is an engineer from NIT, Nagpur, and MBA from IIM Indore. So I'd like to invite Shankar for the next session on the low volatility factor.
Thanks, Vikash. I hope I'm audible to everyone. Great. So welcome, good evening. It's a pleasure to see all of you here, taking time out, especially on a Friday evening. I hope this session, the earlier session and the one that follows, is going to add some value to you as you leave, right? I'll just quickly start sharing my screen. How does it? Okay. So I'm here to talk about the low volatility factor, right? So it's typically considered to be the safety valve of your portfolio. So let's try and understand this a bit more. Let's try and understand what the low volatility factor is all about. It's very simple, conceptually. It's nothing but the strategy of buying stocks which have the highest price stability, which means on a day-to-day basis, these are the companies which don't go up or down by a great number. They may go up or down by a very, very small number. But over a period of time, their growth that happens is very, very linear. It's not in a very zigzag manner, in a whiplashy manner. It is like a smooth line. Let's try and understand this a bit more by using an analogy, right? So there's a new highway that is constructed that goes from Bombay to Goa. And there's also an old highway which is already there. And in fact, that highway is perhaps 50 kilometers shorter in distance as compared to the new highway. It's perhaps even more picturesque. You might enjoy going by that road a lot more than you might enjoy going by the boring road, the newly constructed road. So given a choice, would you prefer the one which is shorter, which has lower distance? At the same time, it is also picturesque? Or would you want to go by the new road, which is longer? It's perhaps a plain road, so there's nothing much to see by the side. If I ask this question to you, I'm pretty sure that most of us is going to come back and say, let's go by the new road only. Ki purane road ka pata nahi. The old road may have potholes. The old road may have zigzag curvature. The old road may have traffic jam. So even if it is 50 kilometers shorter, the new road will actually, the new road is 50 kilometers longer. We may actually end up reaching Goa faster. We may be able to reach well in time to have a nice beer in the evening, right? So that's exactly the philosophy that we would like to extend with respect to market investment, where we invest in companies which have the lowest price movement on a day-to-day basis, meaning they're very boring companies. Just to give you an example, right? And this is just an example to illustrate a point. Does not mean that that's a good company or a bad company. But a company like ITC, outside of being meme-worthy, you don't really want to talk about an ITC kind of a company and say, let's say you're in a party, you don't want to say, I own ITC stocks, right? You may perhaps want to say, I own Zomato, or I got allocation in Nykaa, right? That's exciting. owning low volatility stocks is boring. It's like taking that road which is 50 kilometers longer, which has a boring view, but perhaps helps you reach your destination faster. And something which we never consider, right? The longer route, by the way, because the road is new, it also leads to less wear and tear. It also gives you higher mileage. So overall, the efficiency of your car ride actually is much higher if you go by the new road. Now this is anomalous, right? Because when you talk about finance history, one of the first lessons we ever learn when we start trading, investing, is risk hai to ishq hai. If we want to make more returns, you need to take more risk, right? We have always heard of this statement. But here I am standing and telling you that, boss, invest in the companies with the least amount of risk, and you will actually do better. So how does that work? Now this has confounded not just regular investors like you and I, it has confounded the sharpest minds in economics, it has confounded the sharpest minds in financial academic, and people have tried to come up with an answer as to why the low volatility factor should work the way I'm saying that it will work. So there could be three reasons for this, right? The first one is something called as a lottery effect. What does this mean? This just means that investors always tend to prefer companies which can become a 10-bagger or a 20-bagger or a 100-bagger, right? We don't want to invest in a company. So if I told you there is a company which in a year's time is going to give you 15% returns, and on the other hand, there is another company which I'll tell you, oh, hey, this company can potentially give you 200% returns, right? You are going to choose, or you want to invest in the company which is going to give you 200% returns. You are not going to be bothered by the boring company. So everyone ignores that section of the stocks, right? And everyone wants to focus on only those 100 baggers. What we fail to understand is that these 100 baggers, there is only a possibility of it becoming a 100 bagger. Not all companies that invest in will become a 100 bagger. There is no guarantee of that, first of all, right? Second of all, because all of us are consciously preferring those 100 baggers, we end up overvaluing those stocks. And we are ignoring a basket which is that 15% compounder. And that is now undervalued. Now let's say there is a market crash that happens. Which are the companies which are going to fall the most? Not the companies which everybody ignored, because nobody owned them, right? So there's no question that you're going to sell them because you didn't own them. But you are going to sell the Nikas of the world, you are going to sell the Zomatos of the world, the Paytms of the world. And they were already overvalued, so the pressure on them is going to be that much more, right? So that's one reason why the low volatility strategy perhaps works. The second reason that we have on the slide here is asymmetric returns. This is more mathematical, right? The simple concept which most of us talk about amongst ourselves with our clients, but perhaps not very easy to grasp. So let's say our portfolio falls by 10%. Is it sufficient to go back up by 10%, to come back to parity, to return to zero? Well, the answer is no. If you go down by 10%, you have to go back up by 11% just to get back to zero. Now let's increase the number. What if you go down by 20%? Now 20% is not enough to come back. Even 21% is not enough. You have to go back up by 25% just to get back to zero. Now let's take a more extreme example. What if our portfolio goes down by 50%? Is it sufficient to go back up by 50% to get back to zero? No. 60%? 70%? Actually, you need to go back up by 100% just to get back to where you started at. So that's essentially what it is, right? You have to work doubly harder, 10 times as hard to get back to where you were if you fall by a lot. And what did we say about the low volatility factor? It's a set of boring companies, they don't fall by as much. If they don't fall by as much, they don't need to work as hard, right? So they can work much less hard, so they can actually come back up by a small number of 40%. Market has gone up by whatever, 60%, so they have underperformed by 20% in that period, but they also fell by a much smaller amount, because of which the low volatility factor outperforms. Now this is mathematical, right? And the third reason perhaps is has got to do with overconfidence, which is true of all investors, right? Whenever we are valuing a company, especially one which is a high growth company, which has volatile characteristics, we tend to over extrapolate their return numbers or their cash flows going far out into the future. We may extrapolate these numbers going out for the next 10 years, 15 years, 20 years, even 50 years, and we assume certain growth numbers. And these growth numbers are not 5-7% growth, right, by the way. If we are valuing Nykaa, we are not going to say Nykaa is going to grow by 7% or inflation plus 3%. We are going to say Nykaa is going to go by 50% in the next 10 years. वो 50 का 40 हो गया ना, तो अपना valuation आधा हो जाता है, right? And that can very easily happen. Nobody knows what's going to happen the next year, leave alone the next 50 years. But there is a lot of overconfidence that is built into our own assumptions. As opposed to that, you have a low volatility company where the growth rate is anyway inflation plus 2%. So we aren't overestimating any which way, right? So because of this, the valuation of a low volatility company is perhaps truer of the true value or the intrinsic value of that company, right? So these are three behavioral reasons which lead us to believe that the low volatility strategy is enduring and it works over a period of time. So ये तो ज्ञान हो गया. Let's now talk about performance. Let's see if whatever I said actually is true or if I'm just giving you some gyan, right? So this is a snapshot of the earlier slide which Prateek showed, but I've just highlighted 2 points. This is the Nifty 200 index, which is the benchmark, and the low volatility index, right? So this is the y-axis is the returns, the x-axis is the risk. So you want to be somewhere here. So your risk is very low, your returns are very high. Of course, that is the ideal world, nobody can get there. But look at this. So it is actually returned a CAGR or a compounded return rate of close to 16%, the low volatility factor, right? And the amount of risk it has taken to do that is 16%. Contrast that to our benchmark. Our benchmark has a higher volatility of 22%, which was perhaps expected because we are a low volatility strategy, so it will be lower volatility than the benchmark. But look at the returns are actually lower than the low volatility strategy. So over a period of 15 years, the low volatility strategy has actually not only delivered on its promise of reducing your risk or volatility, it has done so, but at the same time improved your returns over the benchmark, right? And let's take a look at it from a 1 year, 3 year, 5 year, 10 year, 15 year perspective. The picture is much clearer, right? So in the short term, you will see variances. The short term, your Nifty is outperforming. The 3 year, again, it is outperforming, but the performance is catching up. By the time you get to the 10 year mark and the 15 year mark, the low volatility strategy has decisively beat the Nifty. And look at the volatility. Volatility is consistently in the 12% range, sorry, the 16% range, short-term volatility notwithstanding, versus the market which is at a 21% range, much higher, much elevated volatility. So this is what one should really look at, which is risk-adjusted returns, which is how much return are you getting for every unit of risk that you're willing to take. The higher the number, the better it is. And the low volatility factor really trumps out the market in this scenario. Over the long term, it's actually double that of the market, right? It's 2 times as good as what the market is able to offer. And talking about specifically the performance of this strategy across market cycles, when does it outperform? When does it underperform? In bull markets, you can see that it is underperforming. In recovery markets, you can see that it is barely able to keep up with the market. But look at bear markets. Market has fallen on average in a bear market by close to 42%. Versus the low volatility strategy, which has only fallen by close to 25%. And I told you 15% improvement on the downside is equal to more than a 20% improvement on the upside. So let's put the story together. Let's see what this would have meant if one had invested in a low volatility fund back in 2007 and how that investment would have grown if you had stayed invested over the course of 15 years. Now this is idealized, right? This is hypothetical. None of us really had the discipline to stay invested in a strategy like this over a 15-year time frame. But let's just imagine if we had done this. we would have actually doubled our wealth over what the Nifty would have been able to deliver. That's saying something, right? But let's now talk about a bit more detail on how this strategy would really play out for an investor, right? So if you had a holding period of only 1 year, which means that you're a reasonably short-term investor, then your odds of success with a low volatility strategy are good, may not be great. It's 70%. So there's a 30% chance that you're going to underperform. Now let's just expand your investment horizon or holding period horizon from 1 year to 3 years. So now this looks really interesting, right? Your odds of success have gone up from 70 to 92%. So there's only an 8% chance, based on historical data obviously, that you would have underperformed the benchmark. So 92% chance that you would have really outperformed the benchmark. And this number keeps improving as your holding period increases, right? But let's look at some key periods. So low volatility, we said, okay, returns are okay, low volatility is good. But let's talk about what matters the most. A low volatility strategy should help you in a crisis period more than the benchmark, right? So does it deliver on that promise? Because that is promise A. That is the first promise. If it doesn't deliver on that, everything else doesn't matter. So it actually does that, right? So we looked at the last 4 major crisis periods over the last 15 years, which is your global financial crisis of 08, taper tantrum in 13, or your yuan devaluation in 16, or most recently COVID, 2020. Every single period, the low volatility strategy has done better than the benchmark. So your next and most obvious question is going to be, okay, it did what it was supposed to do, but what about the 1 year later? It is going to underperform, right? You're right, it is going to underperform. But I think one of the things that comes out here is that the extent or quantum of underperformance is much lesser. Don't take my word for it. Let's just combine the 2 periods, because we need to see on the way down as well as on the subsequent way up, how has the low volatility strategy done across these 4 periods. So in every single period, the low volatility strategy has actually done better than the benchmark. Simply speaking, it has gained more by losing less. As simple as that. And let's expand this for the entire observation period over the last 15 years. It underperforms when the market goes up on average by about 0.8%, so less than 1% underperformance. When market goes down, it outperforms by 3.5%. This is on a quarterly basis, right? So this is the simple asymmetric nature of the low volatility strategy. This is why we expect that it's a good strategy to hold in your portfolio. So why should you invest? Of course, if one is new to equity investing, wants to get equity market kind of returns, but is wary of the risk, doesn't like so much gyration in the portfolio, this is a fantastic starting point. It gives you lower volatility than the market. But importantly, are you compromising on returns? That, at least historically speaking, is not happening. And that's very, very critical, right? Because we don't want to end up in a fund which reduces risk but also compromises on returns. At least historically, this doesn't seem to be the case. And it is one of the more effective strategies out there in a market crash period, right? So some of the things that a more conservative investor would be wary of with respect to equity market investing, the low volatility fund could be a great entry point for them. And there's a good case to be made for the low volatility portfolio to form a part of your core portfolio allocation. So those are all the things that I wanted to say. Maybe we can move on to the Q&A.
So thanks, Shankar. I'd like to again invite Nitin to take the Q&A.
Thank you. You all can ask questions. You can keep them in mind, and at the end of my couple of questions, you can probably raise your hands and we can start. So thank you for that very detailed presentation and taking us through the interesting components of what and how the low volatility has performed and what makes it tech overall. Can you give a brief on, like, I know you have touched upon the nature of the strategy and all, but the specific factors, you said stable, low volatility is stable, but just not to get into quantitatives, but just a brief on the exact factors that go into making a low volatility index.
Okay. So what is measured is the stock price volatility, which is measured through the standard deviation of the returns. In layman terms, what it means is, if there are two companies going from 100 rupees to 150 rupees in a span of 1 month, okay? Now one company is following the path where it is going from 100 to 170 to 130 to 180 and then finally to 150. And another company is making the same journey but using a different path. It's going from 100 to 105, 105 to 108, 108 to 115. From 115, maybe it is going slightly down to 113, 112. And subsequently making that pathway all the way up to 150. The low volatility strategy prefers the second company, which is very smooth in its price performance, versus the first company.
Of course, I think what you said was a detailed explanation of what you mentioned, but maybe you can just touch upon the quantitative aspect. What is the formula that is used?
Okay, so the formula is the standard deviation of returns. So basically what you do is you measure the returns and you measure the average returns. So let's say over a period of 1 year, you take the daily returns of one particular stock, okay? Now you take the average over that 1 year, and then you measure every observation. So let's assume 252 trading days. So for every day, there is a return. You calculate that return, the difference of that return versus the long-term average or the 1 year average. You square that number. You sum up all the squares, and you take the square root of that. And then you divide by the total number of observations. That's essentially how it is.
Thanks. Maybe some of us who are really interested into how the working goes, probably this cleared some things in their heads.
Absolutely.
Secondly, of course, you talked about the long-run performance and everything. What kind of, as a wealth manager, what kind of allocation do you think an investor or a advisor should allocate to his clients? What percentage? And does that percentage change according to market scenario? What is your take on that?
Right. So the low volatility strategy, like I said in my presentation as well, is more suited, in my mind, as a core allocation to your portfolio. What that means is, you want to have some allocation to this strategy almost all the time. You don't want to really take a tactical call on when you want to invest in a low volatility fund and when not to, right? Which also means that you have to take away some investment from your existing investment, right? So you have to take away a small corpus from your existing investment to allocate into a low volatility strategy. If you're so inclined to really take the benefit of the timing as well, right, where you want to say, I want to time when I want to enter into a low volatility strategy and when I want to exit from it, you could do that. So essentially, you could basically try and invest in a low volatility strategy in periods of market downturn. But unfortunately, it is extremely difficult to predict in advance when a market downturn is going to happen, right? So essentially what I'm trying to say is, if you're trying to time the factor, you're not timing the factor, you're actually timing the market. If you believe you can do a good job in timing the market, then you can use the low volatility factor tactically as well, just before you believe a bear market is going to hit. But if you believe that that's not your approach to investing, you believe in long-term compounding, then having a constant allocation to the low volatility strategy as part of your core portfolio, which you would perhaps not touch and tinker with very frequently, would be what I would recommend.
Thank you. You mentioned risk and how this particular strategy has much lower risk over a longer period as compared to the benchmark. Maybe what people here would like to know is, of course you mentioned standard deviation, but in real context, does it mean that someone who's very conservative can just, comfortably put his or her money and, not fear a downturn or not fear a significant correction or any kind of capital loss? My question is, can this be looked at as slight kind of a debt plus kind of an instrument by anyone?
Great question. I would be mindful and slightly wary of calling this debt plus, because let's keep credit risk aside for a moment. In a debt product, your capital is guaranteed, right? Of course, credit risk is there. So if you invest in junk paper, your capital is also not guaranteed. You're taking on that risk. But let's assume you're not doing that. Your capital is protected, and you get some returns on top. Okay, that's essentially what a debt product should give you. This is, at the end of the day, an equity product. So if you assume that your capital is going to be protected, there is no guarantee like that. Your capital is not going to, so if you ask me whether your capital, you started at 100, the maximum that it can fall is going to be 95 or 97 or something like that. I don't know the answer to that, because that is on the vagaries of the market, right? So from that perspective, it is not a like-to-like replacement for debt. But at the same time, a lot of investors don't like the debt return stream either, right? So they're happy to take more risk than they would be otherwise taking in a debt investment. But they don't want to go all the way as to take the risk of a pure equity market index fund kind of risk. So this falls somewhere in between.
Somewhere in between.
Exactly.
Okay, great.
So for a conservative investor, I think it makes a lot of sense. But of course, with the caveat that they have to invest in equities. If they don't want to invest in equities at all, then it's a moot discussion.
Of course. It's for equity investors only. But those who want a smooth ride, that's what you said.
And especially investors who are on the fence. So someone who wants to take a taste of equity, but always is scared because of some downturn or the other, this could be a good point of entry.
Okay, great. There are a lot of actively managed value funds in the market. So would you say that this is a good replacement or alternative to that? Or any thoughts on that?
So actually value is a different factor altogether. Value, essentially what does value do? Value is basically saying there's a company that's available for you to invest in, which according to the belief of the fund manager or a quant model or something, or an index provider, it is undervalued with respect to some intrinsic value that you place for it. That intrinsic value could be driven by the profitability of the company, so how much earnings the company is making. It could be driven by the sales that the company is doing. It could be driven by the book value of the company. It could be driven by the cash flows of the company. It could be some intangible that you've calculated proprietarily in-house or whatever, right? So you believe that it is trading at a discount. So hence you're picking it up. The assumption is that because it is trading at a discount, there is a margin of safety that is inbuilt in the strategy, because of which it could be low risk. Now the problem is, with this thought process, is that there is no rule in the market which says that if just because something is trading below its intrinsic value, it cannot go down any further. A bottom has been realized. That's not the case. And in fact, that has not been the case for the investing community in the last 10 years. So value as a strategy has not worked in India. It has not worked internationally. It has underperformed the growth strategy, which is investing in the companies which are growing the most, perhaps also much, much more overvalued. If you had invested, let's talk about US because the difference is much more stark there. If you had invested in a value strategy and shorted a growth strategy in the US, you would basically have become bankrupt multiple times over, right? So that's the extent of underperformance of value. Hence, a corollary with value is perhaps not the right example for low volatility. Low volatility is more statistical in that sense. It goes to talk about human behavior, about investing in a set of companies which have very predictable, stable cash flows, which are perhaps correctly valued. I'm not saying they're undervalued. They could be correctly valued. They could even be a scenario where they're slightly overvalued. But there's a lot of predictability with respect to their operating performance. And that predictability translates into the stock price movement of those companies as well. So that's the difference.
Right. Of course, I think we all realize that low volatility and value are different, but maybe there is some kind of a confusion in people's heads. So I thought I'll bring it up. And it was interesting to note that in those four different strategies that Prateek mentioned in his slide, value not only had higher risk but had lower return as well. So why do you think, like you said that value has not performed, but isn't it like, a little counterintuitive? Like value is supposed to give higher outperformance over a longer period?
Great question. That's the hope, right? And so we showed you data for the last 15 years. Unfortunately, India doesn't have very rich data beyond that. But if you look at the global context, if you look at data for the last 100 years, which is available in global markets, US markets, the best performing strategy in terms of returns is the value strategy, right? So value strategy does have the potential to do very, very well. But it also suffers from extended periods of drawdowns. And like we just saw in the Indian context, there was almost a 15-year period when it underperformed the benchmark, right? So that is the extent of underperformance. Now, these are all paper portfolios, right? So I can show you a chart going back all the way to 1920 and say that the value has the highest performance potential. But it also means that I'm expecting that as investors, all of us will have a discipline to stay invested in a strategy which has underperformed for 15 years. If I were asked to place my hand on my heart and say whether I have that discipline or not, I would say I don't have that discipline. Okay? So for the very few small percentile of the population which does have that discipline, value is a fantastic strategy. It still works fantastically well in a portfolio context, right? Because what will end up happening is that it will offer fantastic diversification benefits to your portfolio. Your value will perhaps work when none of the other strategies work. So classic example is Jan of 2022. Value had a positive 10% month. Name any other factor, whether it was momentum, quality, low volatility, everything else was negative. So if you had a value exposure in your portfolio, your returns were smoothened. So it definitely still finds merit in an investor's portfolio purely for the diversification it offers. But as a standalone strategy, it is perhaps the most difficult strategy to continue to have faith in.
Because of the timing and because of the phase of the market.
If you get the timing wrong, then you're in the hole for 15 years. It's not for a year or two. That's the problem.
Okay, great. Thanks for that. I'm done with my questions. If there is anyone else in the audience. There's one gentleman over there.
Good evening, sir.
Hi.
It's a very nice presentation. I missed the X factor, though. See, now today also there was a statement from our Air Force Chief that we should ready with any geopolitical war type situation. So your call on that.
I think he's talking about today's situation, geopolitical situation, and how that volatility impacts the strategy probably.
Sorry, today there was a statement from our Air Marshal Chief that India should ready for a mini war type in the border.
An escalation in the warlike conditions, if India ever has to face that.
So, see, if there is something which is completely out of the blue, then you never know which factor will work. That is going to be a short-term phenomenon. And if it is an extended phenomenon where a full-fledged war plays out for the next 20 months, then again, irrespective of what strategy you have, you are going to see significant underperformance in your portfolio, right? Which essentially means, the point that I'm trying to make is, you can't really predict for every given instance or every given tension, whether it is geopolitical or macroeconomic or based on some other parameter, factor, or pandemic. Consistently, the low volatility strategy has to necessarily do better, right? Because a low volatility portfolio will also have its portfolio characteristics. It will also be filled up of some kind of companies. Now, those exact kind of companies, how their response is going to be to a particular geopolitical scenario or a pandemic scenario or a macro scenario could be very different. What we can only talk about with certainty is that on average, things should perhaps work out, because that is what we have observed in the past. Not just in the Indian context, but even internationally. What we have observed is on average, there is a high chance that the low volatility strategy falls lower as compared to the rest of the market. But if you were to use that as a cue and use this as a purely short-term trading strategy and say, okay, now my expectation market is going to correct by XYZ% because this event is going to happen. Let me take leverage and invest in low vol. Perhaps that doesn't work. So that's my take on it.
So it's a long-term investment strategy and not
Absolutely.
a trading strategy.
Absolutely.
I think that has to be made clear to a lot of.
Absolutely. So just off the top of my head, there are 2-3 companies in the portfolio. I'll name them. So we have a company called Gillette. We have a company called Castrol. And we, I think, also have a company called ITC. And we have a company called Infosys. For every given crisis, this set of 4 companies may underperform. I'm not saying they will not underperform. But will I, as an investor, lose sleep over my investments in these companies? Or would I perhaps be more concerned if I have a much more volatile company, whether I have a leveraged energy play or this or that? I will be more comfortable owning the companies which I mentioned, right? So that is the comfort the low volatility strategy gives you. That's all there is to it.
Great, thank you for that. I guess we can, if there's any other question, or else we can move on to the next.
All right, I see that there are no other questions. Vikas, please come over. And thanks a lot for patiently listening to me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.